on Chapter 8, which is all about long-term assets. And long-term assets aren't anything new. We've been actually talking about them since week 1 of class. Long-term assets are things that a company uses for a long period of time. So that's going to be things like their buildings, their factories, their vehicles, if they use tractors or delivery trucks. That's going to be things like furniture, office furniture, or any kind of computer equipment or office equipment like a copy machine or any other kind of machinery that a company uses. All of those things that they use for a long period of time are what we call long-term assets. And so where we are as far as our tour of the balance sheet, we are still looking at assets, and we're here in kind of the last section of the assets, which are our long-term assets. And I want to differentiate long-term assets from the other assets we talked about, the cash, the accounts receivable, and the inventory. Okay, they're different because those other assets, cash, AR, inventory, those are all considered current assets, meaning they're going to be used or converted to cash within 1 year or less, right? We use our cash, every single day, actually. Accounts receivable, we talked about, take, 30 or 60 days to collect and turn into cash. Your inventory, you don't want it to sit there forever, right? That can be problematic if your inventory sits and doesn't get sold and converted to cash. And usually companies try to sell it as quickly as possible, definitely within a year or less. And that's different than these other assets we're talking about, which are our long-term assets like building, furniture, equipment, machines, all of that stuff we're going to use for more than 1 year, and that's really the big difference. Your book refers to these types of assets as plant assets, but other names that you're likely to see on an actual financial statement are property, plant, and equipment. And also, sometimes they're called fixed assets because they are fixed for, several years. You're going to have that thing for several years. It's not like inventory where the inventory is going to change, every month or 2 months as you sell it and then buy new inventory. Okay. And the three qualities of plant assets are: number 1, they are tangible, meaning you can touch them. 2, they are actively used in operations, meaning the company uses them themselves, and they're going to benefit future periods, so meaning more than 1 year. And again, a lot of this comes from the way that the asset is going to be used. Okay, so the same asset can be called something different depending on each company's purpose. So for example, if Office Depot has a desk and Saddleback College has that exact same desk, these are actually 2 different types of assets for each of those 2 companies. For Office Depot, their intention is to sell the desk. Therefore, it's going to be referred to as inventory. Saddleback College, on the other hand, is planning to use the desk. Therefore, they call it property, plant, and equipment. So it's not so much what the company, what the asset itself is, it's what is the company's intended purpose for it. They plan to sell it or they plan to use it. And that's how a desk can be 2 different types of inventory depending on which company you're talking about. Now, when we think about a long-term asset, we're thinking about a long life. And a lot of things happen within the life of an asset. And as far as accounting goes, there are 3 distinct phases of an asset's life that we need to account for. Okay, the first phase is the acquisition. That's when you first purchase the asset. And the accounting issue we have to deal with there is computing the cost. How much did this asset cost us? It may sound simple, but it's actually more complex. We're going to talk about it in a minute. Okay? The second phase is the use phase. Okay, how do we account for that asset after we've bought it, but we're continuing to use it? So we're going to talk about depreciation, which is a concept we already talked about before in chapter 3, but we're going to revisit it again and learn even more about it. And we're also going to talk about revenue and capital expenditures. And then at the very end of the asset's useful life is the disposal phase, where we actually get rid of the asset. And that is something we are going to talk about in class. So again, that first phase is the acquisition phase, when you actually go and purchase your asset. And the rule for that is that we account for our asset at cost. Well, how do you come up with cost? Well, usually it sounds pretty straightforward. Well, whatever's on the price tag. Okay, but it's not just that. It is the asset price plus any reasonable and necessary costs to get the asset to the desired location and to get it ready for use. So that means that if there is any delivery charges or any installation charges, right? If we're talking about, like a machine, or like if you work in a bakery and the bakery buys an oven, you don't just buy the oven, you have to get the oven delivered to your place of business, and you also have to get it installed and hooked up to the gas and all of that stuff. So all of that stuff is included in the asset's cost. But again, keep in mind, it's only things that are reasonable and necessary. If it's something like out of the ordinary, then that wouldn't count. And we'll talk about some examples of that in class. So just kind of keep that rule in the back of your mind. All right. Next is the use phase. Okay. And the first thing we're going to talk about in the use phase is depreciation. Now, what is depreciation? Again, even though we've addressed that term already in this class, I think that a lot of people still don't quite understand what it means as far as accounting terminology, because that term is used by other people in a slightly different way. But in accounting terms, depreciation means allocating the cost of an asset to expense in the periods in which it is used. Okay? So that means that asset cost that we talked about in the first phase of the asset life, so whatever that asset cost us, we have to spread it out. So that's what allocate means. Allocate means to spread out that cost over the years when we're going to use it. So for example, if you have an asset that costs you $10,000, well, you can't just say you put that cost of $10,000 in that very first year you buy it, because you're not going to use it only in that first year. Rather, you're planning to use that asset for 5 years. So that means you need to spread that $10,000 out into each of those 5 years to show that you're using that asset over 5 years. Okay, so again, there's that term expense. What we're doing is we're turning this asset into expense as we use it, because that term used goes along with expense. So let's review a couple things first, all right? So what is the definition of asset and what is the definition of expense? Think about that for a minute. Okay, well, hopefully you guys remembered that asset has to do with future benefit, okay? And so what depreciation does is it records the future benefit of your asset decreasing or going down as you use it. So depreciation, again, is using your asset. Well, the future benefit goes down, because if you're going to use that machine for 5 years, when 1 year goes away, well, that means you only have 4 years left. So you have to show the future benefit going down, right? So that means, again, if this is year 1, once we've used the asset for year 1, now there's only 4 years of future benefit left. So we went from 5 years of future benefit to now 4. So we have to show our asset going down. The second thing depreciation does has to do with expense. Expense means using your asset. So we have to record what we used in that first year, okay? And again, we use that machine to generate revenue. So we want to record that what we used that year in order to match the expense with our revenue. We wouldn't have been able to sell and produce product and sell product and provide product to our customers if we didn't have that asset. So we have to show like, oh, we use that asset in order to be able to generate revenue in that year. Okay. Now, so we all understand, okay, why does future benefit decrease? Okay, well, future benefit decreases for a couple reasons. One is physical deterioration, right? Look at this car. It is beat up, it is punched in, it is really struggling, right? So your assets aren't going to last forever. Little by little, they're going to get dinged, they're going to get broken, they're going to get slower. Like if you're talking about a computer or something like that, they're just not going to be able to operate optimally. So your future benefit goes down because of physical deterioration. That's why you can only drive a car for so long before it's done for, or why you can only use a computer for so long before it's done for. It physically deteriorates. Another reason is obsolescence. Now, I don't know if you guys watch that show, Saved by the Bell, but this is a show that was popular when I was, I don't know, a preteen, and I loved it. And this guy was Zach Morris, and he had a cell phone that looked like this. Okay, well, those giant brick cell phones, nobody uses those anymore, and for that reason, the future benefit of if that was your asset was a phone that looked like that, well, eventually it would, not have a future benefit because the technology is so old, and we call that obsolescence. So whether it's physical deterioration or obsolescence, meaning the technology is old, either way your future benefit's decreasing. Now, a key concept that I want you guys to understand is depreciation is not meant to be a valuation. Okay, it doesn't mean that whatever my accounting records say, I need to, the way I come up with my depreciation amount is, well, I bought it for this, but now I can sell it for this. So what's that difference? I have to mark it down to what I can sell it for. That is not true. Depreciation is not a valuation. Okay? It is, again, an allocation of cost. So let me kind of walk you through that process. Okay? Depreciation is an allocation of the cost of the asset to expense. So what happens is when you first purchase the asset, it goes on your balance sheet, and then as you use the asset, it goes to your income statement as depreciation expense. We have to show that that asset is decreasing because the future benefit's going down, and the reason the future benefit is going down is because we used it. So what is a journal entry for depreciation? Do you guys remember? We learned it back in chapter 3. Think about it. Okay, hopefully you remember that the entry is a debit to depreciation expense and a credit to accumulated depreciation. Now, we don't credit the asset directly, right? So if this is our machine, right, and we put the cost here of $10,000, we don't want to take anything out of that because we still have that machine, right? The only reason we would ever credit this asset account is when we go to sell it. And like I said, we'll talk about that later on in class. But we don't want to actually credit machine. So this machine always has to be at cost. Okay, otherwise we don't touch that account. Instead, we use this accumulated depreciation account, which is a contra asset. So instead, we put the accumulated depreciation, I'm going to shortcut that as AD, and we'll put the credit here. rather than in the machine itself. And that way we look at those two assets, the asset and the contra asset, sorry for my poor writing there. It's meant to say contra. We put those two together. All right. Now, sorry, this entry here that I showed you guys, I didn't put in a dollar amount. And in fact, on the previous depreciation entries that you guys had to do, I never talked about how do we calculate depreciation. I just said, here's the amount of depreciation, and you just recorded the entry. Now let's talk about how we actually compute depreciation, okay? There are multiple methods. The one I'm going to talk about in this video today is the straight line method, and that is actually the most commonly used of all of the methods. But there's other methods. Another method that we're going to talk about in class is called the double declining balance, which is an accelerated method. We'll talk about that later. And there's even other methods besides that. We're not going to talk about those other methods. I just want you to know that there are multiple methods that a company can use to compute depreciation. Okay? Now, there are three factors that go into calculating depreciation: cost, which we talked about in the first phase of the asset life cycle. The second thing is useful life. That means how long you expect to use the asset. And that is an estimate, right? We don't know for sure, but we, make our best estimate based on, our past experience with different types of equipment or generally how long things are used. Management makes that estimate. And then the third thing we need is salvage value. And the salvage value is the amount you expect to recover at the end of the asset's useful life. Okay, so after I've used my asset for however many years, maybe there's still some value there. And I need to estimate that value. Again, it's not anything that is known for sure. It is an estimate of what we think we might recover at the end. Okay. Now the formula for straight line depreciation is cost minus salvage value divided by useful life. So let me show you an example. It says Jennison Inc. purchased a machine for $10,000. They expect to use the machine for 5 years, and at the end of 5 years, they think they will be able to sell it for $1,000. So I want you guys to take a moment and see if you can identify what is the cost, what is the useful life, and what is the salvage value. Okay, so hopefully you recognize that the cost is here, $10,000. That's what we purchased it for. They expect to use the machine for 5 years, so that would be the useful life. And at the end, they think they'll sell it for $1,000, so that would be the salvage value. And if you go ahead and you plug those numbers into the formula, you would get $10,000 of cost minus the $1,000 salvage value divided by 5 years, and that would come out to $1,800 per year. So the way that would look like, again, depreciation means allocating the cost of an asset to expense in the period in which it's used, is that we would say we use $1,800 every year for 5 years. That would come out to $9,000, leaving $1,000 left over as a salvage value. Because again, the salvage value is the portion of the cost that's not used, right? The cost was $10,000, but if we think we're going to get $1,000 at the end, then that means $1,000 wasn't used. So we only want to allocate the portion of the asset that is used. Again, note, I never said anything about how much the value of that asset was if I tried to sell it after year 1 or after year 2 or after year 3. That had nothing to do with the calculation. Okay, the only time I try to estimate what I can sell it for is that very end salvage value. But the piece in the meantime is not based on that at all. It's just based on allocating the cost. Okay. So what we would do is we would take our journal entry for depreciation. Again, it's those same accounts, debit depreciation expense, credit accumulated depreciation, and now we have a dollar amount we can fill in. We're going to fill in that $1,800. So when you record that entry, this is how it's going to look in your ledgers. You've got your machine, which is the asset itself of $10,000. And again, this is cost. And that amount we're not going to touch until we get rid of the machine. So instead, we put the credit or the decrease in the asset in this accumulated depreciation account. So you've got your asset with your contra asset, and when you put those two together, we do what we call net them, right? Offset a positive and a negative, and we end up with $8,200, and we refer to that as the book value. Again, that term book means our accounting records. Note, it does not mean market value, okay? Does not mean what I can sell it for. It means book value. What do my accounting records or books say the value of that asset is? Has nothing to do with what I can sell it for. Then, if we transfer that to our financial statements, what does it look like? Well, now our balance sheet is going to show property, plant, and equipment of $8,200. Again, this is the book value. And this represents the unused portion of our asset. So the piece of the machine that we haven't used yet. In other words, the remaining future benefit. It represents the remaining 4 years plus the salvage value, don't forget that we have still left in that asset, okay? The income statement, on the other hand, is going to reflect $1,800, which is the portion of the machine that we used in year 1. Okay. Again, telling you again, this is not a valuation. Okay, this is book value, not market value. It just means what amount of that $10,000 cost have I not used yet. So what companies do is they create depreciation schedules, which basically map out the depreciation for the entire life of the asset. So if we've got 5 years that we're going to use this asset, we're going to map out all of those 5 years, okay? And we start with depreciation expense, and that means the portion of the asset used each year. And you notice that amount is the same for every single year. By the way, that's why we call it straight line, because this is the same the entire time. You only have to calculate depreciation once, and you have the answer for all 5 years. Then we look at accumulated depreciation. What's going to happen to that account over time? Well, accumulated means like adding to. So accumulated depreciation is the account where we add up all of the depreciation. So in year 1, it's just 1 year. But in year 2, it's these 2 years together, right? Added up to 3,600. And in year 3, it's these 3 years added up together, right? And in year 4, it's these 4 years added up together. You guys getting the pattern going here? Okay, it represents the portion of the asset that has been used. So we accumulate all of it together. Then we have a column called book value. I shortened it to BV for short. Okay, and again, the formula for book value is cost minus accumulated depreciation. And it represents the unused asset or the remaining benefit. So how much of that asset have we not used yet? And what you'll notice is over time, it goes down, 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 because we keep using more and more of it, so our future benefit goes down, 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 down. Remember, this is the piece that's going to show up as the asset on our balance sheet. So that future benefit is going down, down, down. And if you notice at the end, we go down to $1,000. Well, what's that $1,000? Hopefully you remember. That's the salvage value. Again, excuse my sloppy writing. I'm writing with a mouse. But that's the salvage value, saying, okay, we're going to use up all of it except for the $1,000 we think we're going to have at the end. We'll talk later about what we do with that $1,000. But again, to bring this full circle now to the next year, well, in the next year, we're going to record that same depreciation entry, debit to depreciation expense, credit to accumulated depreciation. The amount is the same in year 2 as it was in year 1. That doesn't change. That's why we call it straight line, because depreciation is the same every single year. And then the way our ledgers are going to look is, again, we have that $10,000 cost still in our asset account. We're not going to touch it because we haven't gotten rid of the machine yet. But what you notice is happening to our accumulated depreciation account is now we have year 1 and year 2 together. So we have accumulated or added up depreciation of $3,600. And again, that's our contra asset it goes against. When we net the two, now our book value is showing $6,400, right? It's gone down. Our future benefit has gone down. And so now our financial statements are going to show the asset of $6,400, which is the remaining portion of the asset that has not been used, the remaining future benefit. And our income statement is showing $1,800 again because we're assuming that we use the same amount in year 1 as we use in year 2, right? Income statement does not accumulate. We only track it for a period of time. So if this is the year 2 income statement, we only used $1,800 in year 2. Whereas the balance sheet is going to accumulate. It's going to tell us how much is left at the end of the year. And then what you're going to do is you're going to continue year after year, recording depreciation each year. And this is what you're going to see. And we'll kind of take a closer look at that in class as well. All right, so now we are on to the third phase of the life cycle of the asset. We're still in the second phase, which is the use phase. But now we're going to talk about revenue versus capital expenditures, okay? So what does that mean? Well, we talked about how future benefit decreases because of things like physical deterioration, right? Things start to break down, they start to get slower and stuff like that. So there are actually things that a company does to counteract that. Okay, and those are any kind of additional expenditures that a company has related to their assets. So that can be usually like things like repairs, replacing stuff, getting oil changes, tire rotations, any kind of repairs and maintenance type of stuff. Now, not all of these expenditures are created equal, right? We have two categories. One is capital expenditures and one is revenue expenditures. Please don't get too caught up in trying to analyze these terms. I think they kind of can be confusing. So just you'll have to do your best to remember them and not try to go, wait, revenue? Why does it say revenue? Don't try to go there. And then sometimes accounting terms can be tricky, but these are the terms, and I'll tell you what they mean, right? So capital expenditure is any kind of thing that you do to your asset that makes the asset better than it originally was, or makes the asset last longer than you originally expected. So if you thought it was only going to last for 5 years, but now you replace the engine of your car, and now the car is going to go for another 3 years. Okay, so now it's a total of 8 years that you can use that car. That's what we would call an capital expenditure. Okay, and I want to contrast that with revenue expenditures. Revenue expenditures are things that just maintain normal operating conditions, meaning it's not going to make it any better than it originally was when you first bought it. It's not going to make it last any longer. Rather, it's just going to keep it so that you can continue to use it. So those are going to be things like regular oil changes, or things that you just have to do to keep it running as normal. An oil change isn't going to make your car faster or make it longer than you originally thought it was going to be. It's just going to keep it going for that full period of time you originally thought you were going to use it. Okay. Now these two different types of expenditures are treated differently for accounting purposes. For capital expenditures, they increase the future benefit by making it better than it originally was. or make it longer than it originally was. So what we do is we record that as an asset because it's increasing future benefit. For revenue expenditures, just things that like keep it running for that, if you thought you were going to use it for 5 years, to keep it running for 5 years, you got to have regular maintenance on it, but it's not going to make it last now 10 years. Those kinds of things like normal oil changes and stuff like that, those are just to continue normal use. So we record those as an expense. Okay, so we're going to talk about those some more in class, but I just wanted to get that explanation out there to you guys. Okay, so like I said in this video, we have gone over three of that. There are three phases, right? Acquisition, use, disposal. Already you know a little bit about cost. At the acquisition phase, you know a little bit about depreciation. In the use phase, we're going to talk more about that in class and learn another technique. We learned about the difference between revenue and capital expenditures, so you can see if you can recognize the difference between the two and how to account for those two. And then in class, we're going to talk about what we do in the final phase, the disposal. So with that, if you have any questions, let me know. Otherwise, I will see you in class.